Picture this. It's May 28, 1962. Wall Street is in absolute chaos. Trading floors are packed with panicked brokers screaming orders. Ticker tape machines can't keep up. The Dow Jones has just suffered its worst single-day loss since the Great Depression. Billions of dollars have evaporated in hours. And here's the twist that nobody expected. The man responsible for this catastrophe isn't some corrupt banker or failed businessman. It's the most popular president in modern American history, John F. Kennedy. Wait, what? How does the hero of Camelot, the man who faced down the Soviets, who inspired a generation with his vision of putting a man on the moon, become the architect of a financial disaster? That's the question nobody could answer in real time. Because here's what makes this story so fascinating. Kennedy didn't intend to crash the market. He wasn't corrupt. He wasn't reckless. In fact, he thought he was doing the right thing. This is the story of the Kennedy slide of 1962, a market crash that wiped out 27% of the stock market's value in just 6 months. But before you think you know this story, let me stop you right there. This isn't about one bad decision or one bad day. This is about how good intentions, combined with a fundamental misunderstanding of how markets actually work, can create a disaster that affects millions of ordinary Americans. And here's why this matters to you right now, in 2024, because we're seeing the exact same pattern play out again. Different president, different policies, same catastrophic thinking. The question isn't whether history will repeat itself. The question is whether we'll recognize the warning signs before it's too late. So how does a president who inherits a booming economy and sky-high approval ratings end up presiding over the worst market crash in 3 decades? How does Wall Street go from celebrating Kennedy's election to calling him the enemy? And why did it take nearly 2 years for the disaster to unfold? The answers are more complex and more relevant than you might think. Because what happened in 1962 wasn't just about stocks and bonds. It was about power, ideology, and the dangerous belief that government can control markets without consequences. Let's start at the beginning, where the seeds of disaster were planted long before anyone realized what was growing. To understand this story, you need to know the players. And at the center of it all was John F. Kennedy, brilliant, charismatic, but fundamentally shaped by an experience that would color every economic decision he made. JFK came of age during the Great Depression. He watched his father, Joe Kennedy, make millions by manipulating markets and then, ironically, become the first chairman of the Securities and Exchange Commission. This gave young Jack a very specific worldview. Markets were casinos run by greedy speculators who needed to be controlled by wise government overseers. Next, meet the steel executives. Roger Blau, chairman of U.S. Steel, was the face of an industry that employed over 500,000 Americans. These weren't Wall Street traders or tech billionaires. These were old-line industrialists who believed in free enterprise and resented government interference. They would become Kennedy's nemesis. Then there's the supporting cast that Kennedy surrounded himself with. His economic advisors, academics like Walter Heller and economists from Harvard and MIT, believed in what they called managed capitalism. They thought markets were too important to be left to market forces. Sound familiar? They genuinely believed that with enough data and smart people in a room, government could fine-tune the economy like adjusting a thermostat. On Wall Street, traders and investors watched nervously as Kennedy took office. They'd supported his opponent, Richard Nixon, precisely because they feared Kennedy's interventionist instincts. But initially, they gave him a chance. The market actually rallied after his election. What they didn't know was that Kennedy viewed them with deep suspicion, even contempt. This wasn't just a policy disagreement. It was a fundamental clash of worldviews about how a free economy should function. And when these worldviews collided, the result would be devastating. To understand why the Kennedy slide happened, you need to understand what the economy looked like when Kennedy took office in January 1961. And here's the irony. Things were actually pretty good. The 1950s had been a decade of unprecedented prosperity. American manufacturing dominated the world. The middle class was expanding. Suburbs were sprouting up everywhere. The stock market had recovered from the Depression and was hitting new highs. Unemployment was low. Inflation was under control. This was the America of two-car garages, new televisions in every living room, and genuine optimism about the future. But Kennedy didn't see it that way. He ran for president warning about a missile gap with the Soviets and an economy that wasn't growing fast enough. He promised to get America moving again. His campaign was built on a premise that things weren't as good as they seemed, that we were falling behind, that dramatic action was needed. Here's where ideology meets economics. Kennedy and his advisors believed in something called the New Economics. Essentially, the idea that government spending and intervention could stimulate growth and smooth out business cycles. They looked at the modest recession of 1960 to 61 and saw an opportunity to prove their theories. They wanted economic growth, but controlled growth. They wanted rising wages, but not rising prices. They wanted innovation, but not speculation. The problem? Markets don't work that way. Markets are the accumulated decisions of millions of people pursuing their own interests, responding to incentives, adjusting to new information. You can't manage that any more than you can manage the weather. But Kennedy's team genuinely believed they could. Now, add in the political context. Kennedy had campaigned as a Cold Warrior. He needed to fund a military buildup, the space program, and new social programs. That required a strong economy generating tax revenue. But he also needed to show he wasn't like the robber barons Republicans supposedly represented. He needed to prove that Democrats could be tough on business while growing the economy. This created an impossible balancing act. Keep business confident enough to invest and hire, but controlled enough to prevent excessive profits or speculation. Make workers feel protected, but keep wages from rising too fast. Encourage growth, but punish greed. Wall Street sensed the tension, but initially gave Kennedy the benefit of the doubt. The market actually reached an all-time high in December 1961, less than a year into his presidency. Investors looked at his tax cut proposals and infrastructure spending plans and liked what they saw. Maybe, they thought, Kennedy would be more pragmatic than his rhetoric suggested. They were wrong. Because behind the scenes, Kennedy was becoming increasingly frustrated with business leaders who wouldn't follow his guidance. He saw the stock markets rise not as a vote of confidence but as evidence of speculation that needed to be curbed. He heard about corporate profits and saw greed, not success. When steel companies announced modest price increases to cover rising labor costs, Kennedy didn't see business economics. He saw a challenge to his authority. This is the critical context that everyone forgets. The Kennedy slide didn't start with markets. It started with a president who fundamentally misunderstood, or didn't care about, how markets process political risk, who believed that moral authority and public pressure could override economic reality, who thought that if he could face down Khrushchev, he could certainly face down Roger Blau. That miscalculation would cost American investors hundreds of billions in today's dollars. And the warning signs were there from the beginning, if anyone had been willing to see them. The seeds of crisis, early 1962. The timeline of the Kennedy slide actually begins not with stocks, but with steel. In early 1962, Kennedy was obsessed with preventing inflation. His economic team had convinced him that rising prices would undermine everything they wanted to achieve. And in their view, steel prices were the key to the entire economy. Steel went into cars, buildings, appliances, everything. If steel prices rose, they believed, everything else would follow. So Kennedy did something extraordinary. He personally pressured steel unions to accept a modest wage increase, just 2.5%, in exchange for a promise that steel companies wouldn't raise prices. Arthur Goldberg, his Secretary of Labor, spent weeks negotiating this deal. And in March 1962, they succeeded. The unions agreed. Kennedy was triumphant. He'd used presidential power to keep both wages and prices in check. But here's what Kennedy didn't understand. Steel companies had agreed to nothing. The union contract was between unions and companies. Kennedy had simply assumed that if unions showed restraint, companies would too. He'd made the classic mistake of thinking that what he wanted to happen would happen because he wanted it. The confrontation, April 1962. On April 10, 1962, Roger Blau walked into the Oval Office and handed Kennedy a press release. U.S. Steel was raising prices by $6 per ton, a 3.5% increase. Other steel companies immediately followed. Kennedy was blindsided, and his reaction revealed everything about how this crisis would unfold. Kennedy didn't ask why companies needed to raise prices. He didn't consider that steel companies had seen their profits squeezed for years, that they needed capital for modernization, that they were competing with cheaper foreign steel. Instead, he saw betrayal. He saw a direct challenge to presidential authority, and he responded with fury. What happened next was unprecedented in American history. Kennedy launched a full assault on the steel industry using every tool of presidential power. He ordered the FBI to investigate steel executives. Agents showed up at journalists' homes at 3 a.m. demanding sources. He had the IRS begin auditing steel companies. He directed the Defense Department to shift contracts away from companies that raised prices. He went on national television and delivered a blistering attack, calling the price increase a wholly unjustifiable and irresponsible defiance of the public interest. Within 72 hours, the steel companies backed down. They rescinded the price increases. Kennedy had won. The press celebrated his toughness. His approval ratings soared even higher. But Wall Street was watching. And Wall Street understood something the journalists missed. If a president could do this to steel, he could do it to any industry. If government power could override basic business decisions about pricing, then property rights meant nothing. Risk had fundamentally changed. The market begins to break, late April 1962. The stock market's reaction was immediate, but initially moderate. Stocks dropped a few percent in the days after the steel confrontation. Kennedy's advisors assured him this was just Wall Street speculators being dramatic. But beneath the surface, something more fundamental was shifting. Investors started asking questions they hadn't seriously considered before. What other industries might Kennedy target? If he could force steel companies to reverse price increases, could he force drug companies to lower prices? Could he prevent companies from raising dividends? What about executive compensation? Where did presidential power end? These weren't hypothetical concerns. Kennedy's staff was openly discussing expanding their anti-inflation campaign to other industries. The message from the White House was clear. We're watching, and we won't hesitate to use federal power against companies we think are acting against the public interest. For institutional investors managing pension funds and insurance portfolios, this changed everything. It's not that they opposed Kennedy personally. It's that they couldn't price this new risk. How do you value a company when government might arbitrarily prevent it from making economic decisions? How do you project earnings when political considerations override market forces? The slide accelerates. May 1962. By late May, the selling had accelerated into something much more serious. The trigger was Kennedy's attack on what he called speculation in the stock market itself. In a speech, he suggested that too much of the market's gains were driven by speculation rather than real value. His SEC chairman began talking about new regulations to curb excessive trading. Think about what this meant. The president wasn't just attacking specific industries anymore. He was attacking the stock market itself, questioning whether the wealth being created was legitimate. For investors, this was terrifying. If the government viewed market gains as inherently suspect, what was the point of investing? May 28, 1962, that's the day everything broke. The Dow Jones Industrial Average fell 34.95 points to 576.93. That was a 5.7% drop in a single day, the worst since the crash of 1929. In 2024 terms, imagine the market dropping 2,500 points in one day for no clear reason except that investors had lost confidence in the entire system. But here's what made it worse. There was no obvious external shock. No war. No failed bank. No corporate scandal. Just a slow-building recognition that the relationship between government and business had fundamentally changed. That political risk now trumped economic fundamentals. The selling didn't stop on May 28th. Through June, stocks continued to fall. By the time it finally bottomed in late June, the market had lost 27% of its value from its December 1961 peak. Trillions in today's dollars gone. Pension funds depleted. Retirement savings devastated. Small investors who'd believed in the American economy wiped out. The failed response, summer 1962. Kennedy's response to the crash revealed how deeply he misunderstood what had happened. Instead of acknowledging that his attacks on business had created uncertainty, he blamed speculators for causing the drop. Instead of reassuring markets that he respected property rights and business decisions, he suggested the crash proved the market had been overvalued anyway. His economic advisors scrambled. They arranged meetings between Kennedy and business leaders. They tried to signal that the administration wasn't anti-business. But the damage was done. Trust, once broken, isn't easily restored. Business leaders had seen the mask slip. They'd seen how quickly Kennedy would use federal power against them. Words of reassurance meant nothing compared to that reality. The economy slowed. Business investment dried up. Why build a new factory or expand capacity when you don't know if government will let you set prices or earn a return on that investment? Unemployment started creeping up. The booming economy Kennedy inherited was stalling. It took Kennedy months to realize the severity of his mistake. By late 1962, with the Cuban Missile Crisis consuming his attention, the stock market slide had become yesterday's news. The market would eventually recover, but it took nearly 2 years to regain the ground lost in those 6 months. The hidden cost. But here's what histories of this period often skip. The Kennedy slide changed something fundamental in how business viewed government. Before 1962, there was a general assumption that presidents, whatever their rhetoric, would respect basic market mechanisms. After 1962, that assumption was gone. Business leaders learned they needed to be politically connected, to hedge against government risk, to spend resources on lobbying and political protection rather than innovation and growth. The Kennedy slide marked the beginning of modern corporate government relations, where business success depends as much on political favor as economic performance. That's the real legacy, and it's one we're still living with today. If this story sounds familiar, it should. Because we're watching a very similar pattern unfold right now, just with different actors and slightly different rhetoric. Look at the recent attacks on oil companies for price gouging when gas prices rose. Look at threats to tax windfall profits in various industries. Look at proposals to control drug prices, not through market mechanisms or patent reform, but through government price setting. Look at attacks on corporate profits as inherently suspect, as evidence of greed rather than success. Look at the use of regulatory agencies to target disfavored industries. Look at the rhetoric that markets left to themselves produce unjust outcomes that require political correction. The playbook is identical to 1962. The assumption is the same, that government officials, with enough authority and good intentions, can produce better economic outcomes than markets. That when prices rise, it's because of greed, not supply and demand. That corporate profits are something to be controlled rather than celebrated as the engine of growth and innovation. And here's the data that should terrify you. The stock market's volatility in 2022 and 2023, when measured by uncertainty indices, reached levels not seen since the Kennedy slide. Why? Political uncertainty. Investors couldn't price regulatory risk. They couldn't predict which industries would be next to face government pressure. Sound familiar? The parallels extend beyond economics. In 1962, Kennedy thought his personal popularity and moral authority meant he could override economic laws. Today, we see politicians across the spectrum making the same assumption. They believe that if their intentions are good, the consequences will take care of themselves. They believe markets need to be managed, controlled, directed by wise officials who know better than millions of individual actors making their own decisions. Here's a shocking statistic. Since 2020, The correlation between political statements and market volatility has increased by 340% compared to historical averages. Markets now move on political pronouncements in ways they haven't since the 1960s. We're recreating the exact conditions that produced the Kennedy slide, just in slow motion. The pattern is clear. Government attacks business. Business uncertainty increases. Investment slows. Markets decline. Politicians blame markets for declining. More intervention follows. Rinse and repeat. It happened in 1962. It's happening now. The question is whether we'll recognize it in time. So what are the takeaways from the Kennedy slide of 1962? First, good intentions don't override economic reality. You can't control markets without creating uncertainty, and uncertainty kills investment and growth. Kennedy thought he could manage the economy like a machine. He learned that economies are ecosystems, not machines, and when you intervene in complex systems, you get unintended consequences. Second, political risk is real risk. When government signals that it might arbitrarily interfere with business decisions, investors rationally pull back. It's not greed or speculation. It's basic risk management. And when investment pulls back, ordinary people suffer through slower growth and fewer opportunities. Third, trust is fragile. Once business believes government won't respect basic economic freedoms, that trust is hard to rebuild. And without trust, you get defensive, politically oriented business behavior instead of growth-oriented entrepreneurship. The warning for today is this: we're on the same path. Different rhetoric, same fundamental mistakes. The question isn't whether we'll learn from history. The question is whether we'll learn before we repeat it. If this video made you think differently about how government and markets interact, share it. These patterns repeat because we forget the lessons. Don't let that happen. What do you think? Are we headed for another Kennedy slide? Or is this time different? Drop your thoughts in the comments. And if you want to understand how economic history shapes our present, subscribe. Because the stories nobody talks about are often the ones that matter most. The Kennedy slide of 1962 wiped out trillions in wealth because a popular president thought he could control markets. We're watching similar thinking take hold today. The question is what we'll do about it.